Okay.
Wearing my clothes from yesterday.
There you go. All right, everyone. Welcome once again to the Exit Your Way Roundtable. Oop, I've got the settings wrong here. Let's get this right. All right. They probably had a wicked echo on LinkedIn there. So, everyone, thank you so much for being here today. We're going to be talking today, as we said earlier in the week and the last time we were here, when we were talking about developing annual projections. We've been going over this for a few times now. Andrew Cross is joining us from New York City today. He's out there doing some business and going to be with us a little while. But Andrew, how are things today?
Calling in from Midtown Manhattan. So
yeah,
things are fine. Had a trip from hell yesterday, but I'm still wearing my clothes from yesterday for the last 2 days because I lost my bag. And the good old times of getting back to traveling.
Yep. So Andrew lost his luggage. The airlines lost his luggage, and it took you 22 hours to get to New York or something like that.
20 hours from Salt Lake City to New York.
Nice. Nice. Well, today, we've been talking about this for the last few episodes of the roundtable, really, because we're going through this with all of our clients at the end of the year, and we figured we would share with everyone here about building these annual projections and really getting your roadmap for 2022 completed and getting that done. So one of the things that we started out by going through the strategic planning. What are we going to be doing next year? What are we going to be doing to increase sales? How is that going to affect our sales? How is it going to affect staffing? How is it going to affect other costs that we've got through the business, and really working through those things? And then we went into last session is where we said, okay, now let's start putting numbers to this. Let's take our historical numbers and the changes that we see happening, and let's build out a projection. And so last time we worked through sales all the way through our cost of goods down to the gross profit line on a profit and loss statement for a business, and got to that point, and had some good questions and good feedback from people. And this time we're going to take it one step further to the end, to the net income line, and we're going to be going from the gross profit down to the net income. We're going to be talking about all those expenses that we have in these businesses, like our buildings, our people, the overhead staff, the advertising, all kinds of things down there as we go through those. So if you're
looking at the opportunities.
Yeah, looking at the opportunities, right? Because this is really the opportunity to run your business, spend your money wisely.
Yeah. I mean, this is analysis, but this is what excites me about this, is because there's gold in those hills in there when you start to look at this stuff and look back and look forward, and opportunities.
Yeah. So we'll start sharing the screen here on our PowerPoint like last time. We're going to flip between the PowerPoint and the actual some of the models that we use. So I'm going to share my presentation screen. And all right, so we should be seeing that in just a moment. Good.
There we go.
Got it.
Yeah.
And all right, so we're again talking about developing annual projections of the net income. This is as simple as it gets. Last time we all want to know what our net income in a business is. I mean, we want to know what that is. And last time we took the total revenue minus the cost of goods sold. And now we're going to be looking at the operating expenses, because what we want to know is the bottom line.
Mm-hmm. Mm-hmm.
That's what everybody cares about, right, Andrew?
Yep. Everybody.
Yep. It's just the way it is.
Yep.
So as Andrew was talking about, this is really your opportunity to figure out how you spend your money wisely, because as we look at these businesses, we have so much sales. It's going to cost us so much to deliver that product or that service. Then we have what's left after that, and that's our gross profit. Now, how are we going to spend that money that we have left after we produce the sales to, okay, you got it. Andrew's got it. So how are we going to spend that money wisely, that gross profit wisely, so that we can end up with good net income?
I
And
think so too. You have to also think about not spending money as well. Is
yes,
identify areas where you're supposed to be spending money
yeah,
and not. And often that's a sign of a
that's for sure. That's a good point, Andrew. So we're going to walk through some of these steps and some of the considerations in each one of the bigger areas. Everyone's got different costs, but I think the methodology that we'll show will adapt pretty well to just about any business. So again, we're looking at operating expenses, and we're going to understand where we're spending money below the gross profit line, what we're spending it on, what are the best places for us to spend it on. So it's like I said, I was going to point it out in our model we'll be looking at. Total expenses. That's what we're looking at. When you look at here right above it where it says gross profit, that's what we talked about last time. We talked about the 18 million in sales, the $11 million in cost of goods, and the fact that we had $6.7 million left over in gross profit. Now we're going to look at how our total expenses of $4.68 million, what that really consists of, and then does it consist of the right things? Because in this case, it's showing that we have a $2 million net operating income.
I want to point out though too. Think about make sure you scrutinize and understand the difference between operating expenses and non-operating expenses. So we still have
Yeah.
a lot of things out there, and from a buyer's perspective or from a deal perspective, we have to look at non-operating expenses and take out, for example, interest or depreciation, or these are non-operating expenses, yet they are expenses maybe on a tax basis, but
Yeah.
those are the kind of things. So you really want to look at, on this kind of stuff as your projections is strictly on your actual operating expenses.
Yep. Yeah. And this kind of projection is the operating expenses. We don't deal much with taxes. And normally when we're doing annual planning, that's a great point, Andrew. We don't worry about depreciation, amortization, or taxes. I mean, they are what they are. We're worried more about, from an operational level, what the business is going to be able to make.
Correct. It may impact cash flow, those kind of
Yes.
things too. And you do have to look for them carefully, because sometimes you need to adjust this when you're doing an operating budget. And you'll see expenses in there that do need to be there.
Yeah.
Or they're one-time charges or an unusual expense that doesn't recur. Those are the kind of things that you have to.
Yeah. Yeah. That's a great point, Andrew, because the profit and loss doesn't project cash flow. It's just projecting what would hit the profit and loss statement. And we could get into a long conversation about that. Maybe that's something else in the future, but it doesn't necessarily show what you're paying in a loan to something else. It doesn't show other things that on a cash basis that you're going to run into. So, but what we're talking about today is the thing that make up your total expenses. All right. So again, where do we start? Boom. It's always, what do? You look at this thing and where do you start?
Unfortunately, I've got to jump off.
All right, Andrew. Thanks so much. So I'm taking it from here. So glad that Andrew could join.
You're in good hands.
All right. We'll see about that. But thanks, everyone. If you got questions, go ahead and drop in the chat. We're going to run through this. Hopefully today, too, we're going to end up a little bit earlier than normal, and want to come back to the tables of Remo and just talk with people for a while and do some networking there. But again, where you're going to start, you want to start with your history and changes. Like we said last time, you're going to take your previous 12 months or get a 12-month, use your history through 10, 11 months, whatever you got, and then just put projections in for your, guesstimates in for your last couple numbers. And then you're going to include the changes. Like when we looked at this, we're going to include the changes. And when we start to talk about these things and work through these history and changes, and we start to work into these expenses, we're going to start with the biggest cost first. When we look at this example, like this is a simple example, the salaries and wages in the operating expenses is obviously the largest number. That's where I would start. In our example that we're gonna switch over to in what we did, it just happens to be that staffing is as well. But this is the easiest way, I believe, to really go through your operating expenses, is to start with the big numbers and work your way down, because they'll obviously affect your projections the most. When we look at these annual net income projections, like in our example that we're going to go over to again, we've got things like advertising, we got auto expense, we've got building costs, we've got cost of money, we've got insurance costs, payroll expenses, professional services, travel, and taxes, right? And these are typical things you'll see. There's going to be other businesses are separated out differently, but this is what we have in our example. So when we look at the biggest cost first, again, we're going to go look at payroll expenses are $3 million on this in this example. So that's where we're going to start. Then we're going to move to the building expenses. We're going to look at that. And then we're going to look at the advertising and others. Because if we look at it, out of the 4,000,007, that's 3,000,000, 4,000,002. So we've covered the vast majority of the dollars in those spends. And if we can optimize those, we're probably going to be doing the majority of the work by going through those categories first. All right. So we're going to talk about, like we said, we're going to talk about staff and overhead. And really what I would recommend and what we use with our clients is a staffing model. And that is just another tab in your annual projections. You'll see it in here where it is the listing of the people, annual salaries, and then are they working or not. And when I say that, you'll know what I mean. But the staff and overhead is, again, it's likely your biggest cost. And it's something that you can easily adjust and move things around, like if you're adding people and things, and you'll see that. So as we go through the staff and overhead, we go back to our strategic planning, like we talked about before. This is what we did in our people section. We said, hey, we're going to add a digital salesperson in Q1. In Q2, we're not doing anything in our overhead. In Q3, we're going to add some more people in here. That's what we were talking about in our example when we went through the strategic planning. And those are some of the changes. Again, when we talk about history and changes. So we'll look at that and go through those. But you need to understand where you're at and what changes you're going to make. And then we're going to model them. So just like last time, we're going to go off-road again, and we're going to hit our model and talk about that. So I'm going to switch what I'm sharing here real quick, and we're going to jump into our multi-year presentation or projections again. And as we go down through, I'm going to try to zoom in. Well, I'm not going to try to. I am going to zoom in. But like I said, we're starting, and if you can see this, we're starting with the gross profit line here. And now we're going to go down and we're going to work on, in this case, the payroll expenses were down here. When we look at it, the overhead payroll expenses section, and I'm going to make it bigger so we can see it. That's what we're working on. That's what we're talking about now. And now, one of the things when you do this, there's actual wages, which we have down here. Excuse me, I'm clicking on the wrong page. When you click here, we got wages, and then we've got payroll taxes. Now, one of the things that you're going to do to make this simple, I think, is to, on your taxes are taxes, right? You can just about figure that there's going to be a percentage of your wages is going to be your payroll taxes. Figure what that out is in your state and your location. Just use a simple formula to calculate it. It's too don't get into just rough it out that way. That's the best thing. If you got retirement contributions, do that same kind of stuff as well. And any other benefits, you know what healthcare is approximately for employees and those kind of things. And then one of the other things that we talk about a lot, and we'll look at this too, is employee entertainment as we go through it. But this really starts out with, I've got a wage details tab in this spreadsheet that we'll look at. So we have our overhead wages, and this is something when you put these together, I personally like to do it like this because I have in here, we have positions, we have wages per month. I don't really care about annual wages. And then I go, okay, I have all my months here to the right. And what this allows me to do is it allows me to then, and then I have where it says number. So you can always adjust. If I don't want this included in my, if I'm going to say, listen, I'm going to hire a CEO in March, I can put this at 0. And the advantage of this, it allows you to really show realistically what your financials should be based on the staffing changes you're making. So this tab then updates everything on your profit and loss. So as I do that, and I'm clicking on the wrong tab again, but when we go back to the profit and loss here, if our wages are not updating right, that should flow through, update this and your annuals on the year and your annuals in those months. And let me go back here on this. I keep clicking the wrong one, but I'm going to show you what I mean. See in these months how the wages are lower, where I adjusted that, and then it goes up to 149,000. This is what makes this stuff easy. These are things that your accounting people, someone else can get this stuff set up for you. But when you have these models set up like this with the staff behind it and the ability to turn, have positions, you're either going to hire or that they're not going to be there anymore. Somebody's retiring, whatever it is. And they tie into your profit and losses where you get to really power in Excel and putting these projections together. So that was a little bit about that. So when you go through this in your staffing, I think as we talk with our clients, the numbers that end up here really are just the result of what you planned over here. I mean, what are you going to do in your overhead? What are you going to do in your finance department? Is it my year that I didn't have AR and AP separated? Now I have to have two people or, separating it out because we're getting busy enough. Are we adding salespeople? These are your overhead kind of things. Do we have to have customer service? I mean, we've got a customer service manual or manager. We've got technical support person in here. I've got 5 service agents, customer service agents, but is it 5? Do we go to 7 after the first quarter because of growth? I mean, you start to think about these things and go back and see what the effect is on your financial statements as you do this, because the real key, or not a real key, but benefit of doing this is looking, what does the effect of me making these changes in staffing and anything else do to my net income? I see so many business owners not really understanding that and taking a look at it. And this is one of the things that gives our clients and people that do this incredible clarity in what that's going to be, because any of these changes that you're doing in your overhead are usually what I call a step function change. Is a variable, like variable materials or something like that, that varies with, if I do more, it's always going to be a certain percentage. It's going to go up or go down with I'm selling more, right? This is not. If I had another finance person, that just means I'm spending more money on that, and that directly reduces my net income. So these things are really important to be able to go through and go back to your strategic planning and figure out by month what you're doing in that part of it to really drive into the net income. And as we are looking, the things that you consider in your payroll expenses obviously are benefits, entertainment. And when we look at the entertainment, that's one thing that, even down to the point of, if you're going to have a company Christmas party and you're going to spend $10,000, $20,000, whatever, on something like that, put it in there, allocate those kind of things, and make sure it's in there, because it all makes a difference in the end when we're doing this. So any questions on payroll, anything like that, or not payroll, but your staffing and ways that you can really model it out for the year that are simple? If there are, just go ahead and drop them in the chat, and we will certainly answer them. I just make sure we got good there. All right. We're going to go back into the presentation again and talk a little bit more about the next part of this, which is moving down the list. As we look at these things and we go back into this, get this going right. We looked at payroll expenses, and then now we got building costs. And when you look at companies, and if you're a manufacturing company or you're something to do with warehousing, your building costs can be significant. And this it's not uncommon to have $1 million or more in your building costs if you're in manufacturing, when you consider all the things that go into it. So we've talked about the big one, which is staffing and payroll and benefits and all those kind of things. And a lot of times too, your benefits roll up from all your direct labor into this section too. So don't forget about including that. And if you got a benefits line up above, you're okay. But if not, you need to make sure to include that in your payroll expenses. But as we move into the building costs, we're going to look at that and take a deep dive into that. When you're in your facility costs, you got to consider a lot of things. You got to consider upkeep. You got to consider things like security. Are you going to do any building and build outs? Are you going to additions, improvements? Those are all the kind of things that you're going to have to consider in what you're going to do in your facility costs for the year. I mean, there's some of it will be expensed and will go on the profit and loss statement like this. And then there will be some that are not. There are more projects that are going to be financed or some other, or balance sheet kind of things. But in your facility costs, there are things that many people don't consider well enough in there. Is like, if you're using a warehousing facility and you're spending $30,000-$40,000 a year repairing forklifts, because you got 20 forklifts running around in there, that's not uncommon. So make sure you're including those kind of things as you're doing it. So messing around with the off-roaded pictures again. We're going to run back into the model real quick here and run through some of the more common facilities costs. And I apologize for having to flip back and forth between these windows, because I don't think there's a way for me to multi-do this. But when we look here and we're going back into the model again, like we said, we're looking at the building costs. And this is another thing that's very common in manufacturing or warehousing buildings is you may pay separate office rent and warehouse rent in the same building. Some people do it, some people don't. If you've got separate offices and warehouse, obviously different. But when we look through this stuff, these are the three that you're going to want. You want to include your rent, any repairs and maintenance, because most of the time, if you're leasing, you're going to have to include that in your cost. The landlords typically aren't responsible for it. Security is another big one that people often underestimate, and that's getting to be bigger every time. And I think some of the last clients we were looking at, it was $2,000-$3,000 a month, and they had to improve it because of the areas they operate and other things. Another one that could be really big, like if you're in a molding company, this can be millions of dollars in a facility every year, just because the amount of electricity that you use. And it's also an opportunity area that if you are spending those millions of dollars in electricity, there's a lot of things that you should be doing, your maintenance people should be doing, and working with the local power providers to reduce that. We've been in places before with the high industrial areas where we're like molding, like I said, because it just uses so much energy that you can reduce that by 15-20% sometimes, and really do that. And then if there's any other miscellaneous costs, I've got a couple miscellaneous in here that I just stuck in to do that. So it's simple in your warehousing. And when you look at this on a monthly basis, it's the biggest thing to consider in your building is, from looking at next year, is get your increase, because there's usually a percentage increase. So we look at our historical, we got a 3% increase, roll that in, and make sure you're budgeting for repairs and maintenance and security and utilities, and throwing in a little bit for the unknown. That's the keys that I would really emphasize around the building costs when you're doing that. And if there's any questions as we're going through this, please drop them in the comments there as we're going along. All right. Well, that's with the building expenses. And like I said, we wanted to just briefly go through that part of it. And we're going to go through one last piece of this. And then we're going to spend a little time here on Remo just talking. But we were off-road there. Now we're going into one that I think many people underestimate. And that's advertising. This is what we have it in this case. But when we look into this, and if you're selling things, you're selling products, a D2C or a B2B, your advertising cost is something that honestly we really didn't look at 25 years ago. We didn't. It just wasn't a part of the overall. And now it has to be a part of the overall. And we're gonna look a bit more at that and look at how it is, because when you look today, we might have done television, radio, newspaper, or magazines before, but now we talk so much more about internet and other types of media that we're going to have to do in our advertising, let alone how much people are spending on things like tech stacks and other stuff. And we'll talk about that a little bit when we look at that part of it. So we're going to go off-road one last time again and run through that on our projection sheets. So when you look at the advertising, and this is direct advertising, this is a section now. This can easily be much more, much less. In this case, this company spends 2.3% total on advertising. That's not a lot anymore. If you're a direct to consumer brand, you could be spending a lot more. If you look like a Red Bull or somebody like that, heck, they spend 15-20% of their overall revenue on things like this. But know what you're doing, right? Know what you're doing, know what you're getting for it. If you're spending on PPC marketing, make sure you're getting your money for it. Again, all this stuff is budgeted on a monthly basis. If you're going to phase things in and out, make sure you're doing that in your projections and rolling things like you want. Like in this case, our PPC is actually just set based on a 2% is what in this example we're going with there. But when you look at this, there are so many costs in this part of it anymore. When you look at things that we weren't doing before, it was company websites were made and just kind of left set. Now outsourced marketing is very common, and spending $2, $3, $5, $10,000 a month. It just depends on the company and what you need. And then when you look at other things like content development, I can't tell you how many companies never even thought 10 years ago about content development, and now are spending, tens of thousands of dollars of this a year. So when you look at your advertising and really put that together, work with your salespeople, your marketing people, and get those things in there right. And as trade shows come back into play too, make sure you're understanding those costs and getting those things included in there right. So we're really trying to figure out again how we're spending our $6 million, $6.7 million we've got in gross profit. How are we spending that efficiently and driving it to the net income line? We talked about, so we've got the advertising in this. That's $426,000. There's auto expenses and stuff. I'm just going to run through them quick here. We talked about building as a big one. You're going to have the other things, janitorial, communication, continuing education, janitorial, computer, tech supplies. That's one that it hits a lot of people that they don't budget nearly enough money. Replacement costs on computers, and the actual on the consequence of that, the amount that it costs people when you have too slow of computers. Continuing education, there's a lot of companies that do that. This is where this stuff all gets put into the financial models to really give you your net income. So that's about what we were going to go through on here. I'm going to stop. I'm going to go back to our presentation and wrap up there real quick, and we can jump back in here and answer questions and do those kind of things. So we're off road there one last time, but this is where your rubber really hits the road. If you go through these steps in your expenses, go down through them, look at them on a monthly basis, like we talked about in the other step where we went through the down to the cost of goods line. It tells you how much on an annual basis you could expect, how much you should expect on a monthly basis from both. You've got these gauges. You can say, hey, we should have made $1 million this month. We should have net profited $100,000 this month. If we didn't, great. Or we need to look at where we're not performing. And this is what it gives you looking forward into the next year. So that is the end. And we did finish a little bit early, so we're going to have some time to talk here at the tables. I want to, first of all, next time, what we're going to be talking about is we're going to take these annual projections and show you how you break these down into monthly and then weekly goals. And this is where the power of your annual projections really come into play. It's like, listen, this is all fine and dandy, but how are we going to get there? And that's where giving people like your salespeople the goal of you're going to have to bring you're going to have to, we're going to have $1 million in sales a week or whatever the right amount is. We'll look at that next time and talk through those. And then how do you structure meetings to make sure that this is being looked at and reviewed and the right people are talking about it on a monthly basis? So on a weekly basis to drive the right monthly results. So I'm going to quit killing people with a PowerPoint presentation and stuff like that. We're going to go back to the tables here on Remo, and we are going to be back next year. We're not sure yet if we're going to come back on the 6th or the 13th. I think those are the first two Thursdays of the month. But we just wanted to thank everyone for being with us, stopping by, listening on LinkedIn, reading the blog posts on YouTube, and just want everyone to have a wonderful holiday season, however you're going to celebrate it, and look forward to what we can do in 2022. So I'm going to end the broadcast on LinkedIn Live, and then we're going to turn over back to Remo, and we're going to talk to the tables for a while there and move on about our day. Thanks so much. All right. I'm going to jump down to the table here and say hello.